To start off the entire discussion, how do you feel about going ahead with investments here on?
It's a situation where one needs to be cautious, but at the same time optimistic as well. Instead of just managing money on an ad hoc basis, understand, plan, prioritize why are we putting the money, for what purpose are we putting the money, what is the time frame of this money that we are going to invest for. Think a little bit about that, and in a structured manner, it's time to sow seeds again.
Right, let me first ask this lady, you are a housewife, ma'am?
I'm a school teacher.
Okay.
My name is Mrs. Sudha Menon.
Where would you need the maximum help when it comes to saving more to be able to make the right kind of investments as well?
Well, I've got to cut down on my shopping, which I love doing, and also on traveling.
All right, we have a doctor in our midst as well. Doctor, but what about your investments? Are they in place?
My investments are in place, but I've lost some money in the share market. In fact, my query to our expert today would be, is it the right time to get into the share market?
We keep getting this question over and over again. How does one play the equity markets at this point?
There's a standard rule. When you have 100 rupees and if you think you want to put it into equities, into the stock market directly, you never put all the 100 rupees on day one on the same day. We can't time the market. We don't understand what's going to happen. Nobody can predict what's even going to happen an hour later. So if you've got your 100 rupees, instead of putting it in today and seeing the market crash by another 20% or 10%, and then you feel that your 100 has become 80, if you just spread this money over a 6-month period, one, of course, you'll get an average price, or the other thing which will happen is even if there is an 80% correction, it's only that much allocation that you've put in which will be corrected by that 20%, but not the whole portfolio.
Right. How many of us participate actively in the equity markets over here? You do? Right. We had another gentleman who is a retired employee. So your name is?
My name is Ashley.
And you were just telling me a while ago that you've invested actively in mutual funds.
Yes, I did, and I'm not getting any returns.
Right. In a situation like this, when you've just retired, you've invested actively in mutual funds, and now we've seen that kind of erosion. Now is the time that you really need that money, Karthik.
Can I just ask you an extension question? Have you put all your money into an equity mutual fund?
Say about 30% in mutual funds and 10% in the savings and a little in post office.
And the other 60% is in post office?
Yes.
Number one, because you're already retired, you need to depend on a cash flow. That's
yes.
One. Second, you need that cash flow to increase every year. And the third, you obviously want the cash flow to move in line with your lifestyle's
yes.
expenditure. Do not get locked into any kind of an investment product which is going to block your money. In my personal opinion is you should always keep the corpus liquid, very flexible, so that you can increase your outflow when you want it, you can decrease it when you don't want it.
Where do I invest? How do I invest?
Where do you invest is the question. Now that the money is going to come out from the post office, now where does he put that money?
Okay. You can have the benefit of investing into your same FD kind of a product, your same postal kind of a product, but do everything through mutual funds. Because through mutual funds, you don't only get equity, you get bond funds. You can invest in income funds, you can invest in corporate paper, you can do a lot of things.
Okay.
But the greatest advantage is it is far more tax efficient for you. At the same time, it is totally liquid. You can get your money out in 3 days, your total money.
Right. We have a question over here as well.
I'm not agreeing with what Karthik is saying.
Sure.
Because whatever I have invested in the fixed deposits 2 years before, and at the same time when I invested in the mutual funds, at least I'm getting some return.
You are comparing an equity mutual fund to a fixed deposit, right? That's a wrong comparison. See, mutual fund does not mean equity mutual fund only. Mutual fund, you go to a portfolio that has a bond portfolio.
Right. What about the ladies over here? Sorry, you have a question? Sure.
I have just 1 year back retired, and my daughter is going to get a medical degree within 2 months. I have put my money in fixed deposit. Now, to start her clinic, should I break my fixed deposit and give her the money, or should I ask her to take personal loan from banks and start her clinic? I'm in dilemma.
Right. Can we solve this dilemma for the gentleman?
See, this is a very emotional thing. I think differently, you will think differently, all of us will think differently. But I'll tell you what I think. I think a parent's responsibility ends when you complete giving education and strength to your children to fly. Okay? Then let them fend for themselves.
The lady over here doesn't agree. One thing, Karthik. The lady over here is laughing at this. Tell me why. Yeah, sure. We will come back.
I'm feeling a sense of relief.
Yeah, you're feeling a sense of relief.
Well, sorry, I mean, like I said, that's my personal view, you see. If she's going to set up a clinic, and if the family money is only your fixed deposit money, you put the money into a clinic, is she going to make you a partner in the business?
I don't
No,
know.
I mean, I'm being very,
we
very...
have not talked yet.
Though it's a family thing, I'm being very practical about it. How are you going to live? See, today you're thinking you're going to depend on the interest that you will get from your fixed deposit, right?
Yes, correct.
So if you're not going to get the interest, are you going to get a share in the business that she's going to run? That's an important question which you and your daughter need to answer amongst yourselves.
We have another question over here as well, Karthik.
My name is Dr. S.R. Agarwal. I have two types of investment. One is for a charitable trust and one is a personal investment. In charitable trust, I invest 50% in the FD, 50% in mutual fund. In case of personal surplus money, I am investing 60% in the shares and 40% in the mutual funds.
Please clarify, when you say mutual funds, are you talking equity mutual fund? Are you talking bond mutual fund? What are you talking
The
about?
bond mutual fund, and I am investing through a consultant. I am not investing my own.
So you are investing into bond funds, basically.
Bond funds.
So that means your allocation is 60% equity, 40% non-equity.
In case of personal surplus money.
In case of personal surplus.
In case of a trust, it is 50% FD only, 50% in the mutual fund. In the last 3 years, from 2005 to 2008, there was almost 100% growth in both shares as well as mutual fund.
Okay.
In this year, everything has gone down.
It's gone down 60-70%.
And now I'm completely confused. Even consultant is also at a standstill. He is not advising much.
Now, let me tell you a few, 2-3 examples. In the months of October, November, December, that last quarter, we have seen in our own Indian scenario, mutual funds, you know, gold has given almost about 60% returns. In the last 8 to 9 months, do you know that bond funds have given you more than 12-14% returns? Let me answer your mutual fund question. Okay, I want to take you back to 2000, and that I think should give peace to a lot of people. You see, go back and look at a lot of mutual fund schemes that we have in our own Indian scenario. I'm talking equity mutual funds. What was the worst time you could have invested the last time? April of 2000. That's the time we had the IT boom and then the subsequent crash. So between the period of February to April of 2000, February, March, April, those 3 months, the stock market was the highest it was, the last peak. Had you invested into an equity mutual fund at that time, from there, obviously the values fell. After 4 years, that is in 2004, the value of those same mutual funds almost doubled in 4 years' time, and the boom had not even started. Then the second boom did not even start in 2004. It all started, like you said, from 2005 and 6, correct? From 2004 to 2008, it doubled again.
Double, correct.
So, if you had invested at the worst time of April 2000, your investment is still 4 times today, in today's crashed market. Okay, in January of last year, it had doubled again. So, you were actually at 8 times, instead of 8 times, you're at 4 times. But 4 times a multiplier of money in an 8-year period is still a return of 15 to 17%, which is still by far the best return that you can get, and that is the best asset class to be in.
Equities is the best asset class even at this point in time when we are seeing the markets go their way they are. We are at this housing society in a special episode of Smart Money. As we go into election mode, people want to know what exactly the next government can do for them and how their investments are going to pan out. We're going to do that in just a bit, so don't go away, stay with us.
This program is brought to you by ING, Banking, Investments, Life Insurance. And New Fiat Linea, Admiration Guaranteed. And Sector, No Limit Watches for Men.
Strong coffee?
आपको लगता है रिटायर होने पे जिंदगी ऐसी ही होगी?
क्यों ना?
पर ऐसा ना हुआ तो बिरला सन लाइफ इंश्योरेंस के रिटायरमेंट सॉल्यूशंस, ताकि महंगाई चाहे बढ़ती रहे, आप कल भी जिए आज की तरह।
एक और कॉफी?
Dress code, Reed and Taylor. As the street gathers more crowd.
Probably you have a scenario with a high inflation and no growth.
As an increasing inflation generates more heat.
What drives the market is a combination of positive variables.
Are your investments at a greater risk than ever? Tap the right financial opportunities and find the key to the best financial planning. Tata Capital and UTVI present Invest Wise. Get a better perspective on financial planning at these times. Exclusively on UTVI.
Brought to you by Tata Capital. We only do what's right for you.
At a time when it's hard to see what lies ahead, and even harder to stay on course, our experience and capabilities can make the future easier to navigate. When it's tougher than ever to be a tiger, it's even more important to know what it takes. Accenture, high performance delivered.
A lot of questions here on this special episode of Smart Money. We have lots of questions coming up as well. This gentleman has a question. Let's just see what it is.
See, my name is Simon DeCosta. We work for Citizen Forum G North as well as Consumer Guidance Society of India. Now, lots of people were abroad due to this recession. I mean, they had taken their children abroad, given the best of education with the kind of money they earned. Now, suddenly they are sent back. Here, there is no money, and there, the child is stranded. How does such parents overcome this problem? One more thing is that, though the child has not completed the education, the parent is back because of the recession abroad.
In professional financial planning, the kind of work that we do, you know, the first thing that we tell a person when we do planning, before even we start planning, the first thing that we are trying to see is, do you have something called a contingency fund, which is equal to, say, 6 months of your expense? Of course, now a person doesn't have a contingency fund, you are back. What choice do you have? You have to look for a job here, whatever you get with a lower salary. I mean, it's obvious. There is nothing really special that I can say in this situation. The other thing is, whatever little savings you have, however bad your loss is, if you need some money to run your family, what else? What choice do you have? But then that should be a lesson that, listen, let's understand that this thing can happen again. Okay, we are not immune to that. It has happened in US. There is no reason why it cannot happen in India. But first thing, your first objective in life should be to make your safety parachute. Put it aside so that whatever happens in life, you are okay. Till the time your life gets back on track.
You have touched upon the area about the insurance, health insurance, etc. What is the criterion for that?
It's a part of risk management, right? You do a life risk management, you do health risk management. The first thing you need to do is get a Mediclaim policy. If you are salaried, then something again that most of us don't tend to do, ask your HR, read in detail about the group health cover that you have or the group insurance that your company has taken for you. Please read it in detail. See if there is any benefit there. You know, sometimes there might be a benefit, but it'll just be worth 50,000, which is not any good. Then you need to supplement it by your own Mediclaim policy. You should at least have 3 to 4 lakhs of Mediclaim cover. These days you get these floater policies also. So you could take a 5 lakh or a 6 lakh floater policy for the whole family. Anybody in the family could use the entire amount. If something happens, there'll be a huge bill. But otherwise, it's a cost for living. So you'll have to sacrifice that premium every year.
Right. Now, our lady over here, we're talking about contingency funds. Now, she's thinking of a job change at some point in time.
Yes. Well, I'm planning to give up my job right now within a few months.
Okay.
And switching over to something like freelancing.
Okay.
But I'll be getting a corpus when I retire from this job, which I give up. So where should I park it so that in case my, future plans don't work out that well, I still have something to fall back on?
Okay. There are two things that you need to do. First, whatever is your expense, basic living expense, you should have 6 months into that basic living expense. That's an ordinary rule. Because you're going to get into freelancing, you probably need 12 months. Because you don't know how your revenue will look like. That money can stay into a bank account which is linked to an FD. You have these kind of products where the money is in a savings account, but you get deposit rates on that. Or alternatively, you could go to a liquid or a cash mutual fund. That's the idea. So that is what you do with your contingency fund. With your other fund, it needs to be planned in such a manner that it will give you some amount of supplementary income, which will take care of paying your gas bill, your electricity bill, your telephone bill. So it won't be a huge amount of money, but because we don't know what's the corpus that you're going to get. But whatever you're going to get, we should try and plan it so that it gives you some amount of income, right? Now, if the corpus is very large, we can invest it to get only 7 or 8%. If the corpus is smaller, then we need to gradually up the risk a little bit, maybe to the extent of 9% or 10%. And when we talk a 9 or 10%, then we're talking equities to the extent of about 30 to 35%, maybe 40%. And the remaining staying in bond funds. You have a mix of the two, okay, and start withdrawing. You can get into a withdrawal program, and you can start getting the mutual fund to pay you a monthly check. So it's going to be some part of profit, some part of your own capital, okay. In good times, you will be totally on profit. In bad times, it will be some part of your capital also. Some mathematics needs to be done here, But a broad rule of thumb is that you can expect a 7-8% on your corpus. Park it, get a monthly check that comes in. Whenever there's a profit, they'll declare a dividend. You'll get more.
Now, here's a gentleman who's saying that, look, a lot of analysts talk about equity markets and that's the place to be right now, but he has a fundamental issue.
Without being derogatory to the expert who's with us today, I'd like to say that there are so many experts who are giving their opinion in various media. As a consumer, I'd like to know who is the person to believe. The second important question which arises out of this is, who is the expert out of these, or are all these experts who are guiding us themselves rolling in wealth? In the sense that if they're following all that they're asking me to do, then they themselves should be multimillionaires or people who are in the top of the world. So I'd like to know which of these experts have reached that pinnacle, so then I'd like to follow their formula.
It's a very valid question, Karthik.
Yeah,
perhaps
very valid
you can
question.
give your own personal balance sheet and how it's looking at this point in time.
I want to address the second one first. You have to know somebody too close to look at the personal balance sheet. That's the only way to do it. But on the first one, on a little serious note, who's the best expert to trust? It starts with you. You're the first best expert because you need to know what you want to do. Like I just mentioned a while ago in the show, just saying that here's my money, I have the money, what to do with it. See, because you ask that kind of question, you get that kind of an answer. So if the question is different, that's why you need to do a little bit of thinking yourself. What is it that I want to do with my money? What are my objectives? And then you speak to the right person. See, when you do a simple thing like buying a shirt, you're going to 5 shops and checking it out, right? So in terms of experts, why don't you do a little bit of shopping for experts?
You said you speak to 20 people. Now all 20 of them, being professional people, will paint a very rosy picture of their viewpoints.
No.
So when they speak about their viewpoints, is that the right viewpoint? How do I know that? I am not a financial expert.
Okay, let's understand 2-3 basic things. What are the assets that create the best kind of return for you? Equities do, real estate do. These come somewhere top of the line. Okay. The next assets are non-equity assets, which are bond assets. Understand what you should expect from these assets. From an equity asset, you should expect 12 to 15%. You should expect that much. What you get is a different story. You should expect that much. From a non-equity asset, you should expect to get whatever is the interest rate prevailing, which could be anywhere from 4% to 6% or 8%. Once your expectations are in order, no matter what expert says, ultimately you know that the horizon to invest in equity is 5 to 7 years, because there is a business cycle happening every 4 to 6 years. Which is why I said the first expert is you.
Right, I'll just come back to more questions. We need to take a small break here again, but Smart Money will continue. And all these people over here who've gathered at Anand Nagar Housing Society here in Mahim in Mumbai, they are waiting to ask those questions to Karthik. He's not telling us exactly how his balance sheet is looking, but we will talk about that and much more on the flip side. Stay with us.
Smirnoff cassettes and CDs from Sony BMG.
लेडी सिंगल्स की मैच हो रही यार, बीवी को बोलने ये सीरियल वीरियल बंद कर दे।
ये कितने सेल्फिश होते हैं हम मर्द लोग। हमारी बीवियां हम लोग के लिए व्रत रखती हैं, मन्नतें मांगती हैं, जब तक हम घर नहीं पहुंचे खाना नहीं खाती, और हम एक मैच नहीं छोड़ सकते उनके लिए। छे, लानत है यार। अरे ऐसी बीवी के लिए एक मैच क्या पूरा टूर्नामेंट कुर्बान।
ड्रामेबाज। नए टाटा स्काई प्लस में रिकॉर्ड फीचर है, यानी जब मैं ये सीरियल देख रही हूँ, इनका मैच रिकॉर्ड हो रहा है, जो ये महाशय बाद में देखेंगे।
टाटा स्काई प्लस, इसको लगा डाला तो लाइफ और भी जिंगा लाला।
It's a tough year ahead for the economy. Can the UPA balance expectations with action? Find out on a special episode of Eye on the Week. This week at these times, only on UTVI.
At a time when it's hard to see what lies ahead, and even harder to stay on course, our experience and capabilities can make the future easier to navigate. When it's tougher than ever to be a tiger, it's even more important to know what it takes. Accenture, high performance delivered.
back from our short break here on Smart Money. Lots of questions that are waiting to be answered over here, so I'm going to come quickly to them. Sir, you had a question.
Yeah.
There is a golden rule in the investment that you should see the three things: safety, return and liquidity. Now what weightage we should give?
There's a fourth dimension, time. The time that you have will decide the other three factors. So if you have a longer time, then you can have safety, liquidity and return even with an equity share. If you have very little time with you, you can have safety, liquidity and return with a fixed deposit. So the asset class depends on the time factor that you're going to choose. So time is your most important dimension.
Just now you said person should make arrangement for contingency fund. Now in what way he should invest in contingency? Just he has to keep the money in cash at his home, or he should deposit as fixed deposit in the bank. What about if the bank goes bust?
A small percentage, maybe 25% of this money can be kept as cash at home. The remaining money, yes, you can put it with the bank, but there is a little bit of a risk. I mean, these days, because we hear banks crashing, we feel even that's a possibility that even a very large, reputed national bank can also go bust. Mutual fund is a better structure there, at some point. The reason for that is a mutual fund is constituted as a trust. That trust has certain beneficiaries which are defined by the constitution of that trust deed. The beneficiaries are people like you and me who are known as unit holders of that trust. So irrespective of a bank going bust or irrespective of a fund manager not being able to manage that fund, the fund is separate from the company. So if you are investing in an HDFC mutual fund, you are putting money to the trust. The fund manager is HDFC Asset Management Company, which is a different entity. So the entity who is managing can change, but the trust remains. And by the definition, by our Indian Trust Act, trust has money from unit holders or contributors to the corpus of the trust, and there your interest is perpetual. So a trust can only go bust if all the money is used up in a bad fashion or bad decisions are taken, but that cannot happen because you have full transparency and everything that a trust is holding, you know, on a month-to-month basis. So I would think that there is a case there to invest in a liquid and a mutual fund kind of a situation.
Right.
I wanted to know how safe our money is in nationalized banks. There was talk of even the banks crashing. So what do we do? How do we divert the money from fixed deposits?
The logic is this. If I'm going to get a return of 7%, as an example, and if inflation is at the same 7%, am I actually making money or losing money? Or I'm making nothing? See, my 100 rupees in fixed deposit is going to become 107 next year. But if inflation is 7%, to buy the same goods that I'm paying 100 rupees for in this year, I'll have to spend 107 next year.
Yeah.
So where is the sense investing in a fixed deposit? Or for that matter, in a postal or anything else? I think the first principle of financial management is invest in something where your post-tax return is at least equal to or more than inflation.
Now looking at this Satyam episode, so many investors have invested in shares, especially Satyam. Now I want that you should throw the light on this episode.
Sure.
And now when we are discussing about Satyam, my colleagues or those who are discussing among ourselves, we are asking the questions to ourselves, is it only Satyam or there are so many hundreds of companies are like Satyam?
Even if they are there, you will not know.
Even as we speak, Karthik, the Corporate Affairs Ministry is talking about looking into accounts of various companies beyond Satyam, because now suddenly they feel that perhaps a lot of wrongdoings happen elsewhere as well. So where is the faith going to go? How does one invest in the equity markets in a time like this when there is skepticism all around?
Let's talk about where we lose money. Out of all the companies that are there, in how many companies like Satyam have we lost money versus how many companies have we gained money? The simple logic or rule of investing into an equity market is look at a business that has been around for a long time, look at a business that is basic, a business that is a fundamental requirement, who have a professional management, make an investment there. Satyam would quite qualify into that bracket also, but that's a bad, unfortunate event. So overall you get a better picture. That's why we say don't put all your money into one basket, right? That's why we say keep diversifying. Even if you're buying into equities, buy into a broad-based portfolio. But don't buy into one sector, one industry, one company.
I guess there will be lots and lots of questions that still remain unanswered as far as personal finance is concerned. That's the kind of space that we are living in, and these are difficult times indeed. Karthik, I want to thank you for joining us and for helping us solve some of the problems that we've got from this wonderful bunch of people. from this Anand Nagar Society here in Mahim in Mumbai. But of course, if you have more questions, don't forget you can keep writing in to us. Our email ID is very easy. It's smartmoney@utvi.com. And this is not just for you, for our viewers over there as well. It's smartmoney@utvi.com. And then, of course, there's the SMS number, which is 59995. What you need to do is SMS SMART. Put your name, your city, and your question with spaces in between. You send it across to us. And, of course, we'll get some of the best experts in the business, like Karthik Javeri over here, to answer them for you. Thank you indeed for joining us. And thank you for watching. Bye-bye.
This program is brought to you by ING, Banking, Investments, Life Insurance. And new Fiat Linea, Admiration Guaranteed. And Sector, no limit watches for men.
See, we've had 4 or 5 years of very good agricultural years, and so the probability is that we may not have as good a year in agriculture for 2009 for 2 reasons. One, that we may not get as good a monsoon as we've been doing for the last 3 or 4 years, and 2, because of already the high growth rate that has been achieved, it will be difficult to maintain this growth rate in agriculture sector in 2009.
Presenting sponsor, Videocon, Ecologic for a sustainable life. Knowledge partner, CII.